50 Shades of Barrels as choke points are held at Flashpoint. That's not a movie title, that's today's shipping market. From VLCCs in the Middle East Gulf to LPGs rerouting in the Pacific, freight rates are swinging wildly as the Israel-Iran conflict escalates. Are we witnessing a new super cycle or just a fleet panic premium? Hello everyone and welcome back to the Saigal Seatrade podcast. I'm Research Analyst Shruti, your host today, and I'm joined by shipping expert Mr. Sandesh for a deep dive into what's really moving these markets and where we could be headed next. Sandesh, welcome back.
Thanks Shruti, thanks for inviting me once again. We have a lot to unpack today and let's go ahead.
Alright Sandesh, let's kick things off with the VLCC segment. The Middle East Gulf China hit world scale 70 last week, and that's a sharp 67% weekly rise on TD2. What's behind this explosive move, and more importantly, is this the floor of a new bullish cycle or just a geopolitical sugar high?
Well, absolutely Shruti, and I love the phrase geopolitical sugar high, because that's exactly what this market feels like. So what we are seeing in the VLCC segment, specifically on the Middle East Gulf China route, is a confluence of fear, fundamentals and forward-looking sentiment. So let's break it down. First, the Israel-Iran conflict is acting like jet fuel on the sentiments. So charterers, they are scrambling to lock in July stems early. And you may ask why? Because everyone is worried about the Strait of Hormuz. The 20% of global oil flows through that one choke point, and when missiles fly, tankers pause. And that created a vacuum in tonnage early last week. So we saw Middle East Gulf China freight rate for rocketed to world scale 70. And then we have TD3C, it climbed up 51.81% week on week to settle at world scale 81.75. So owners, they immediately seized the narrative, held back tonnage and pushed back on offers. So the early July window became gold dust and charters blinking first. But last week, by the midweek, something interesting happened. So repeat fixtures at world scale 70 started coming through, and that hinted at a temporary ceiling. So it's almost like the market reached peak fear, at least for now. So by the weekend, we saw only marginal upside. Now contrast this with the West Africa charters shifting their focus there, because they were also fearing Middle East escalation. We have WAF Far East rates, they kind of firmed up as, ships got soaked up quickly. Then we have seen the TD15 benchmark, it jumped 38.5% week on week to world scale 72.63, and sentiments remained firm. But again, volumes didn't spike, rates rose because of kind of a redirected demand and not the new barrels. Moving on to the ex-US Gulf, here the market started slow but got turbocharged midweek. We saw ex-US Gulf China rate ideas leap from 6.1 million to 7.97 million, and then TD22 it got up by 30.5%. With the wide gaps in charter owner expectation, and you know what, that's a classic sentiment spillover. So to summarize, this isn't the fundamental driven rally. You know what, it's a risk pricing, plain and very much simple. So whether it sticks upon on two things, will the conflict escalate and will demand keep pace? Because if it doesn't, we risk a rapid unwinding of this freight froth.
Well, that's a powerful setup. So let's narrow in on the Suezmax and Aframax moves now. So the TD6 and TD20 both posted decent weekly gains, up nearly 9% and 16% respectively. Is that VLCC driven or is it something else brewing in those segments?
Well, Shruti, that's a great observation. So what we are seeing in the Suezmax and Aframax segment is what I would call the trickle-up effect from the VLCCs. So when the VLCC spike, charters start looking for alternatives, specifically if they are dealing with the slightly smaller cargo parcel or they want more flexibility on the routing. So yes, Suezmax benefited early last week, and PSUs for instance did test waters with two cargoes, one of which fixed for ex-MEG East Coast India at world scale 133, but then sat back to reassess. So meanwhile, ex-WAF Suezmaxes, they had a strong start but faded midweek. And you may ask why? Because there is a limit to how long sentiments can defy fundamentals. So volumes, they didn't increase, ships didn't disappear. So rates softened slightly by Friday. Now flip to the Aframaxes here where it gets kind of a spicy. Because we have seen TD8 benchmark, it surged by 18% to world scale 159.57. And then we saw MRPL fix at world scale 185. and whispers of another deal near world scale 190. So this is where geopolitical meets positional tightness. The early July window is thin and owners are playing the hardball, and guess what? Charters are blinking again. Now coming back to ex Southeast Asia market, it also saw a significant rally. TD14 benchmark, it rose nearly around 19% to world scale 125.63. And you know what, with the deals printing around world scale 125 to 127, again tightly stable cargo flow and just enough risk to give owners leverage. So in short, it's a classic freight pyramid. We have seen VLCC rise, then the Suezmax follow, and then the Aframax follow next. But unlike the top of the pyramid where sentiment rules, these mid and small segments still rely heavily on the real cargo volumes and tonnage lists.
Sandesh, the clean product market feels like it's walking a tightrope right now. We are seeing MR freight firming up sharply east of Suez, LR tonnage getting strategic, and the west of Suez markets sending mixed signals. From withheld tonnage to war risk premiums, it's all getting priced in but unevenly. Can you take us deep into the CPP split between East and West and help us understand where these things are heading?
Well, absolutely, Shruti. The CPP market right now, it's under a pressure cooker, not because of volume alone, but because of the fragility of logistics and the charter psychology and premium risk stacking on top of each other. So let's break it down by region, then layer the big picture on top. So starting with the east of Suez, we have seen the MRs. They are kind of one of the sharpest weekly recalibration in the months. So what we are really seeing here is less about demand routing barely and more about owners repricing risk. So with the Strait of Hormuz turning into geopolitical minefield, many North Asia based ships, they are now reluctant to ballast down to the AG, that is Arabian Gulf. And that's a 7 to 9 day deadhead with war risk premiums now surging fourfold to nearly 0.20% of hull value for just a 7 day transit. And that's not pocket change, it's a kind of a structural shift in operating cost. So you may ask what happens next. The prompt tonnage list in the AG is drying up fast and owners, they are holding back, playing the waiting game, and that's pushed MR rates sharply higher. It's all about the opportunity cost, and that's what driving this quiet upward boil. Then we get to the LRs, LR1 out of AG Japan. The TC5 route is assessing at $29,478 per day, an extremely tight number. But forward value is kind of a buckle. It drops 38% by September 25 to approximately 18,500 and lingers under $15,000 per day into calendar 26 and just above $13,000 per day by calendar 27. So yes, traders are paying top dollar now, but the curve screams oversupply. The LR1 market has hit a ceiling where charters, particularly for Japan-bound cargo, are kind of starting to resist, and we are already seeing signs of recalibration as some of skipping AG early and sourcing from the Southeast Asia or West Coast India instead. Now coming back to LR2s, they are kind of a different beast. They have remained firm on the AG Japan routes. It was around world scale 207.5 last week, which for the first time of the year is very elevated. But what's telling is that charters are paying for flexibility, specifically for the diesel or jet cargoes to East Africa. And the regional instability has changed discharge preference for traders now, and they want the optionality to divert mid-voyage if needed. Also, in addition to that, 10% dropped in the Middle East jet fuel demand from 0.55 million barrels per day to around 0.48 million barrels per day in just 1 week is creating a localized oversupply of product. Now combine that with the 1,500 flight cancellation since the conflict reignited, and we are now seeing more jet and diesel flowing into Africa and even in the Southeast Asia. So this shift is further tightening LR availability and amplifying premiums. Now moving on to and zooming out to the west of Suez, the story flips. So we have got a bifurcated market here. So on the UKC US AC run, that is TC2 benchmark, the rates kind of a slip to world scale 117.5, down world scale 2.5 week on week basis. And while UKC WAF, they kind of gained slightly to world scale 142.5. So it shows how even minor shift in demand centers, they can skew the regional sentiments. The Med has been kind of a more stable because we have seen the Med USAC route, it held at world scale 130, and while made WAF it held at world scale 150. But underneath it's fragile. So demand is not growing, and what's holding these numbers up is limited relate availability, and in addition to that some of the cross trading inefficiency. So charterers they are waiting and owners they are hesitating. So it's a market trading water. Cross made and cross UKC runs were steady at world scale 130 and world scale 145 respectively. And meanwhile Black Sea made held at world scale 160, and at the same time Baltic UKC it held at world scale 155. So both inclusive of EU and ETS cost. But again, fundamentals don't support these levels. Long term freight is simply reacting to arbitrage sentiments and not the volume. Now, across the Atlantic, we saw something remarkable as US Gulf Coast to Caribs. They broke around $1 million for the first time in 2025, and it jumped $350,000 on a lump sum basis week on week. While the US Gulf Coast and East Coast Mexico route, it held at $150,000 lump sum basis. So the big one is, of course, US Gulf Coast and Chile. It surged to $2.4 million for 38 KT, and it was up by $200,000. So this isn't just demand driven. It's a squeeze, lack of triangulation, tight prompt tonnage, and ultimately owners resistant to discount have caused rates to leapfrog. And overall, we see the wild card is Israel with the refinery shutdowns. They are poised to increase gasoline imports fivefold to 50,000 barrels per day, and then diesel sixfold to 60,000 barrels per day. And that could add incremental support to the med freight. But even that won't offset the product shortfall from the lost refining capacity. So you may ask what's next if the US involved in the military with the Israel-Iran conflict, and we are not just talking about the spikes, we are talking structural repricing. So AG East LRs they could soar beyond world scale 250 if risk premiums become embedded. So until then, you know what, it's a fragile equilibrium because the market held up more by fear and supply gaps than by trade volume.
Well, that was a smooth breakdown, Sandesh. Now let's switch to the LPG segment. The Ras Tanura Chibas testing the low $90 per metric ton, and the USGC Chiba is back in the mid $120. Are these just war premiums, or are supply fundamentals playing a role too?
Well, Shruti, LPG, the market that often flies under the radar until it suddenly explodes. And you know what, right now, both east and west of Suez are getting interesting, but for a very different reason. So, east of Suez, the story is all about the risk premiums. Very few owners, they want to go anywhere near the Arabian Gulf unless they are getting paid extra. And that pushed Ras Tanura Chiba rate ideas into the low $90 per metric ton, up from the mid $80s per metric ton just a week prior. About 7 fishers they got done for first half of July, and mostly in the range of $85 to $89 per metric ton range. We have an Indian utility even fixed just below Baltic equivalent of $90 per metric ton. So the list for the first decade July is getting thinner by the day. Moving into the US Gulf market, it's an entirely different ball game because the Houston Chiba route it climbed into the mid $120 per metric ton range, and only 6 fixtures were done for the late July. So what's the problem? The real problem is the US Far East arbitrage. It's still a very narrow, and the US LPG stock they aren't building fast enough to support a full blown rally. But owners, they are kind of encouraged by the TCE premium versus Middle East Gulf and holding out for stronger numbers. So we have a tale of two market where one is east, where freight is being driven by geopolitical fear and kind of a regional avoidance. And then the second one is west, which is trying to ride on those coattails, struggling with own supply and constraints.
Well, that brings us to the end of this episode, and thank you, Sandesh, for joining us today.
Thanks, Shruti. Thanks once again for inviting me. It's my pleasure to share my thoughts with our audience and with you. Thank you.
And to all our listeners, do not forget to share and subscribe to our podcast. Until next time, navigate safely and stay tuned.